Okay, good afternoon to everyone. I'm sorry for this short delay. First of all, thank you very much and welcome to all of you to this new event held by the Sustainability Committee of CFA Spain. As you already know, the CFA Spain with the Sustainable Committee is working in coordination with industry leaders to keep developing an industry standards on ESG investment products with the aim to promote substantial investment in the Spanish financial industry and the aim of developing ESG financial analysis and education projects. As a member of the CFA Society Spain, you already know how important it is to stay adapted in an ever-changing marketplace. The latest area of growth is environmental, social, and governance, ESG investing. That's why CFA Institute now offers the CFA Institute certificate in ESG investing. Now you can obtain the ESG knowledge needed to get in this competitive edge in the industry. The CFA Institute certificate in ESG investing will help you get a grounding in first, analysis, valuation, and integration of ESG factors, constructing and managing ESG integrated portfolios, investment mandates, portfolio analytics, and client reporting. You can find more information about this degree in the CFA Society webpage. And today, I think we have a really interesting topic. Before we get into today's topic, I would like also to thank our sponsors, without whom all these conferences and events that we are holding by the Sustainable Committee would not be possible. So thanks to BlackRock, GAM, Amundi, AXA, Aberdeen, and Hermes Federated. Today's topic is valuation of assets with ESG criteria from suppliers to internal models. We have the pleasure to have AXA Investment Management and Lauren Claver that will cover many things that are relevant in today's ESG challenges, like ESG scorings, methodology, ESG metrics, tools, data availability, ESG providers. It's really a pleasure for us to have Lauren Claver. He's the head of Quant Lab Core Investment in AXA IM. Lauren was previously head of research and head of macroeconomic research. Prior to AXA IM, he worked for 2 years of the French Statistical Institute as the head of the forecasting unit. At the end, we will have time for questions. So please, if you prefer to write those questions in the chat, I will ask them to Laurent, or you can ask it directly if you prefer. So many thanks, Lauren and AXA, for being today with us. Lauren, the floor is yours. Thanks again.
Thank you very much. Thank you for having me. So I'm going to share my screen. Here we go. That's what I want to show you. And if I do, just going to try to see if I can. Hold on, I can do full screen, I think. That would be better. Like now you're probably full screen, so I'm in very little. Again, thank you for having me. As was said, by training, I'm an economist, which could come as a surprise. So, but a French one, which means a lot of emphasis on mathematics. And so Quant Lab, which is really a transversal unit at AXA IM, which helps all our investment platforms with quant content, so investment analytics, risk metrics, also has in charge the quant ESG, so KPIs that we need to have to do responsible investing, and also the integration of those KPIs into portfolio management, from model portfolio to actual day-to-day asset management and portfolio management. The topic is well, quite topical for me today, because we chose what we've been doing. So that's what I'll show you on slide 2. Is it's been AXA IM and responsible investment in ESG date back a lot. So we've been doing this for more than 20 years. really. And it's been very different from one to the next. So 20 years ago, when we started that journey, we were kind of trying to figure out what we wanted to do. And then we thought how, and at the time there were very few metrics, the coverage was very low. And then as it went, the markets, our clients were catching up. We obviously joined the UNPRI. And then progressively we developed our methodology to cover more assets. We tried to harmonize those methodologies. And then at some stage we considered that we had reached a point where we thought maturity was good enough in terms of ESG metrics that we should create a framework that would cover all listed assets in a similar way. I wouldn't say in the same way because that would be a bit much. And then quite recently, and that's what I want to talk about today, we chose last year to switch from what I call a blended score, which is a classic in asset management, which is to take a couple of ESG data providers and to mix what they give you. That's what we used to have. And we moved to what I call a hierarchical or an organized scoring system, which if you work in finance beyond ESG, you'll understand very easily what I'm referring to. When you have a price, so the price of a bond, for example, you refer to a data source, let's say, I don't know, Bloomberg. But if Bloomberg is not covering that issuer, then you might have a backup, which might be Barclays. And if Barclays is not covering up, you might have Merrill Lynch. And if nobody is giving you the price because it's illiquid or a niche market, then you'll develop your own pricer. So you'll have an XIM pricer. That's what we've done for financial instruments for years. But we're doing the same for ESG scoring nowadays, and I'll show you how. The next slide is everybody, all asset managers who are doing responsible investment will tell you that they're great at it. So we're great at it, of course. But the thing is, it's easy for me to say that. We find that it's better when others say it of us. So these are three examples. So it's the PRI, so the United Nations to the left. There are ratings up to A and A+. We're A+, we've been A+ for years, but there are plenty of other asset managers who could say exactly the same. There are plenty that are A+. It's basically what you have to be. But 2 years ago, for the first time, the UNPRI realized that everybody was A+, so they had to do A++. And so that was called the leaders group. If you look at large asset managers, so above 200 billion euros of assets, which is what we are, we're at 800 billion euros. In Europe, there are only two that qualified. And one of those two was XIM. The one bottom right is the exact opposite in terms of source of ranking. It's coming from an NGO. So very activist, very aggressive. They don't have, as in they don't manage assets. They don't, they're not from finance. They're called Reclaim Finance, which says it all. So very aggressive NGO. And last year they launched their first review of asset managers in terms of climate alignment or climate commitments. We were number one. This year, they've done it again. We're still number one. To give you an idea of how activist they are, they ranked, I don't know how many asset managers. They consider that of all the asset managers they review, only 2 are doing enough. So XIM is doing just enough, according to an NGO. We're very happy that we're doing enough. That we think it's very important. So moving on, let's get to the topic. First, I have to say, considering the invitation, I actually did take my CFA certificates in ESG investing, so I am certified now. I took that September, October last year. And so, and it is true that it's very interesting. Even if you do that for a job, which is my case, and in my team, quite a few people do that. I encourage them to take it, because just going through the manual, you actually learn stuff. It's a bit like, you know, reading the newspaper. You discover that everybody doesn't necessarily do things the way you do it. So you probably know very well how your house is doing it. But by reading this book and learning it, you get to you know, open your eyes to other possibility. The first thing that, as a scientist with a scientific background, I wanted to discuss is, okay, so ESG is a metric. It's what's referred to as a KPI, a key performance indicator. So, and again, as was said in the introduction, my background at the very beginning was as a statistician. It's not very fancy. So today you would say a data scientist. It's a lot cooler. But it was about data statistics. And so the mantra at the French Statistical Institute was measure to understand. And so the natural question in ESG is, but I mean, how much do we measure really? And then to understand, but to understand what? And I think that's a key point that you need to have when you think about ESG scoring and the integration of ESG metric in your allocation, in your asset management is, why are you doing this? And so the first answer should be, well, the classic is, well, the regulator says, my boss says, and usually the real boss is your client. So your client says, okay, that's the why. But what is it you're trying to do? If you look, obviously the parallel is obvious, it's credit rating. What is it you measure with a credit rating? The ex-ante probability of default. So of a credit event. And the second step is the ex-ante probability of a downgrade, what's called a migration. It's very important because then ex post, you can check what happened. So you can check, was the default rate of AAA lower than AA, lower than A, and so on and so forth. And the answer is yes, on average. That's the reason it's very well reflected in market prices. What is it we're trying to measure with ESG scores? So our ESG scores go from 0 to 10. Most people do something similar. Sometimes it's with letters, but basically it's the same idea. Let's say 0 to 10, 0 is the worst, 10 is the best. So let's imagine we say AXA, so the company I come from, has an ESG score of 9, which is great, like really good. Today, 9. In 2 years' time, or 1 year time, I don't know, if we go back and look at what AXA has done, how will we know that we were right with that assessment today? How do you know that the score of 9 is the right one? Why is it not 0 or 2 or 4 or 6? If you cannot ex post say that you were right or wrong, then any number is acceptable. 0 is just as right at 5, 6, 10. It's the same. What the slide is obviously showing, which is very well documented in the CFA ESG handbook, is the low correlation between ESG scores. So the bottom, you see the cloud, it's all over the place. It's MSCI, which is, you know, a standard in this market, versus FTSE, which is another score provider. I mean, what do you see? Do you see a direction? Do you see a correlation? Standard correlation is like 0.3, 0.4. The correlation between credit risk ratings is above 90%. The point I'm trying to make with this is, it's not as much how much we measure, but what we measure. That's what you get on the next slide. This is something I would encourage you to go to and read. The MIT, so probably the world's best university, has a project, an academic project called the Aggregate Confusion Project, which is looking precisely into this, ESG scoring. What do they say? How much do they converge, diverge? And what are they for? What is the information they contain? And what they showed in their study, which I find super interesting, is what you see on those two charts. Those are 6 different ESG data providers, and for firms, I've taken out the names because I'm not allowed to quote names, but actually if you go on the MIT's website, you'll find the paper, and the paper quotes every single name. You can tell that for a lot of firms, the distribution is super tight. So they all agree. We all agree what are the good and bad companies. for some of them. And for some firms, here you have the worst disagreements in terms of single names, so 25 names on which it's all over the place. I'll get back to that. It's a very important point. So what have we done at XIM? We've traveled, as I said. So we're now at our 4th version of ESG scoring. And I would actually call all of them proprietary. It's what we use, and it's ours, it's our thinking. As I said, we started, and you can tell on the scope, 1 to 2 billion. It was all integrated into a single RI team that was very small. We were only doing European equity. And basically, we're just scrapping data here and there and kind of trying to figure out something to say. It was a narrative, basically. In the version 2, we had a large client, AXA, as an insurer, who wanted to have an assessment of his ESG risk. And here, you're starting to see where I'm getting. ESG risk. Okay, so now we know what we're looking for. We're looking for a risk. That's interesting. It's probably not what everybody is looking for, but at least that client was starting with, there is a risk. I want it mapped. I want it measured. Suddenly, we wanted 400 billion euros of assets. So you don't get to do that with an Excel file, a couple of people, and no thinking. So you need to sit down, start thinking how you're going to do it. Suddenly, it was all equity, all fixed income, so all the credit exposure, only on developed market. But still, again, here we were juggling with a bunch of data providers, and it basically looked like a scorecard. What I explained to my clients and internally when we discuss climate investing is that climate investing today, which I'm sure most of you guys are trying to deal with, today, that's where ESG was in 2012. So we're trying to figure out how to measure. We were doing scorecards, basically. We knew that none of what we were looking at was harmonized and that everything was sector specific and region specific. And we knew that the coverage was not good and that the data quality was not good. But we wanted a scorecard, something that highlighted risk that then we could delve into. In 2018, we looked into building a harmonized scoring system. And by 2019, it was live. It was, as I said, a blended score, which is a classic, what most asset managers use. And that means you take some KPIs from, in our case, MSCI, some KPIs from Sustainalytics, some KPI for a third data provider, you mix, and that's your ESG scoring. And so last year, we moved to what we call Q-square, qual and quant. And that's the structured scoring. And that's what it looks like. We've decided that the first input, you remember my story about first you take Bloomberg. By the way, I don't work for Bloomberg, and that's actually not how we do the prices of bonds at XIM. But we do have a first data source that is our reference, the golden source. And yes, we do have a backup when that source is not available for a specific bond. It's the same. So here on ESG, our starting point is the MSCI ESG score. Now, we do know that their coverage is not impeccable. So there are names, especially on the emerging market space, on the high yield space, and on the small mid-cap space, where they're just not providing the information. And we want to map our risk. And what I learned in data science is what you don't measure, don't pretend that that's irrelevant. It's a bit like a street light. So a street light is providing light, but it makes the rest of the night even darker. And the criminals or whatever is bad is not waiting under the street light. It's in the dark. So if you want to properly map your risk, you better not dismiss the fact that your coverage is not good enough. And that's the upper layer of our Q-square system, is you have alternative data providers that you're transforming internally into MSCI-like scores. Not necessarily with some kind of complicated algorithm, you're just telling your analysts, and here we get into resource, so you need corporate analyst, a research department that looks at various inputs, Bloomberg, Sustainalytics, investment banks, you name it. It might be specific to your market. We know that in Asia, they have specific boutiques, high yield. You turn to something else that provides you quantified information so that you can replicate the MSCI framework on those names. That's one. The second is this orange triangle. The orange triangle is, as you can tell, it's a layer. So it's also adding coverage, which is what we call qual to quant. So a name that apparently MSCI is not interested in. It's particularly the case on the fixed income space, where if it's public debt of a private name, so it's the name is not listed as an equity, but it's issuing debt that is public, listed, exchangeable. Then it shows up in a credit fund, in a fixed income fund. MSCI doesn't necessarily cover it because it doesn't exist as a stock. And we do a lot of fixed income, as you probably know. And so expansion of coverage through our own analyst. But you can tell that it's not just a layer, it's a triangle that gets into the MSCI circle. And that's because just because MSCI is our first input, it doesn't mean we agree with everything. And so when we disagree, and that's what I put in the previous slide here, we can agree to disagree. We don't have to follow what they say. So sometimes you need to agree to disagree. That's what we do. That's what we do here. Now here, you can't just say, well, I disagree, so I override it, and then I can have it in my fund, and my fund is great. And that's not how it works. You know that because that's not how it works for credit ratings. By the way, because of some directive and because also we have a proper risk management, we don't use credit rating agencies like this to assess our credit risk. We have an internal credit risk assessment, of course. We're a fixed income house, so we take credit risk very seriously. So those are inputs, but we have our own system. Is it highly correlated with credit rating agencies? Of course, we're looking at the same things. So we very often get the same assessment, but sometimes we disagree. So you can't just decide that you disagree and override. What we have put in place is a governance where the analyst does the research, and so it goes, and here it's very important to stress why a structured scoring system is very helpful. If you do a blend is what? You take this blue, the green, the yellow, the gray, you mix and you get some kind of a brown thing. Well, then when somebody says, I disagree with the score, it's brown. You don't know what you disagree with. You disagree with some kind of weird weighted average, rescaled, transformed mix of 3 to 4 data providers. What do you disagree with? In this case, which is exactly what we've been doing for credit risk, so it's the same for ESG risk and credit risk, you go on the MSCI ESG Manager website, you download the report. Let's say AXA, I just said before, it has an ESG score of 9. Let's say you're like, no, that's not true. Okay, let's go on MSCI ESG Manager. You download the report. You have probably like 80 pages from MSCI, and it's actually an analyst, and they have like almost 250 to 300 analysts, ESG analysts. So you get a research report, 80 pages long, telling you how they got there, how did they get to decide that was the score. You give it to your corporate analyst and you go, okay, read this. Tell me what is it you disagree with. And that's exactly what they do. They go and then they go like page 51, they say this. Yeah, sure, that was true 2 years ago. It's no longer true. And by the way, page 110, that's never been true. I don't know what the guy was thinking, but that's just not true. It's a big mistake. This is just not true. That's still not good enough. That's factual, documented, auditable. But you still need to have a governance. So what we've done is that's the first step. So we disagree. The corporate analyst produced a research paper explaining where and why he disagrees, propose an alternative scoring, and then we go to what we call the ESARC, the ESG Score Assessment and Review Committee. And here, the corporate analyst will explain his research. It's been sent ahead, obviously. and there will be a vote. And we're not trying to redo his research. I mean, it's a professional, he has a manager, he is CFA certified, but we're just peer reviewing. And then there's a vote. The vote is only research people. It's our chief economist, our head of RA research, our head of credit research, our head of US research, and our head of equity research. Only research people. They all vote, 5 votes. If ever for one reason or the other, because somebody would not vote. Obviously, our chief economist has the last word. So that's how it works. Very simple, done. The following day, it's implemented in a tool that has been developed at XIM, which is, I don't know, techno tool. So we have a trace of when and by whom it was overridden. And we see it's a dedicated, it's not just anyone who has writing access to that tool, everybody has read access to that tool, and so you can trace when it was changed. The following day, it's in all front office tools. So managers, portfolio managers can manage with that new score. So that's the idea. Start with an input, decide with a due diligence which one you trust the most. Experience helps a lot. Put an upper layer, otherwise you'll have massive holes, especially in high yield, emerging market, small mid caps. And then do question the scores. Just because you thought they're the best doesn't mean you have to agree on everything. Some data is not updated fast enough. Some data is just wrong. And of course, there are cases where they just misunderstand what it is. One example I love is there was a state-owned enterprise. And MSCI flagged the fact that the compensation of the director, which was labeled CEO, it's not really a CEO, it's a direct managing director, was not linked to performance. And a state-owned enterprise, a lot of them, there is no compensation linked to performance. It's just not acceptable in some countries. Does it make it a weak governance? We don't think so. It just means that the country, in this case France, has in its law that you don't get to have performance pay, performance comp when you work for such an enterprise. Fine, they misunderstood the structure. Doesn't really matter. And in terms of governance in the G in ESG risk, we think this is okay, and therefore we'll be right. Let me move on because I find that otherwise I'm going to run out of time. Here are a couple of slides which I can share, which details how they've put their methodology and what we flag as particularly interesting to us. I'm not going to get into the details. Actually, the CFA manual explains as well the MSCI methodology, so you're probably quite well versed into that. Another feature that we've had for a very long time, which is pretty obvious, is the issues, but it will open the door to something a bit fun. The issues, the KPIs, so the sub KPIs into the ESG score that you want to look at are sector and even subsector dependent. So of course the weights are not the same because the materiality of those risks is not the same depending on the sector. The typical example is a utility has a larger, much larger impact on the environment than, I don't know, say a pharmaceutical company or a service company. So the weight should be larger. An insurance company should have a large G. Yeah, it's what we do, and so on and so forth. I get to the core of what I wanted to say at the very beginning. How come we chose this? Why MSCI? And this is literally not a judgment of value. We don't think it's a better company, a better provider. No, that's not the reason. The reason is it's more in line with what we were looking for. And that is literally the conclusion of the MIT paper is if you know what you're looking for, if you know why you're doing ESG scoring and ESG integration, then use the ESG provider that has the same interpretation as you do to ESG scoring. So in my view, there are at least 3 reasons, and maybe there are more, but 3 main reasons I can think of why we would do this. One, and people get very confused between the 3, they think it's the same. It's not the same. One is value. And by that, I mean moral values, ethics, what you think is right. what you think is good, and vice versa, what you think is evil or wrong. That's a slippery slope, to be honest, because it's actually quite linked to culture. So some things that are considered unacceptable in some regions and some cultures is considered rarely good, but can be considered okay and acceptable. So I'll give you one example. There are very few countries, I don't even know that there's one, where tobacco is illegal. As a subsidiary of an insurance group, we considered that financing something that is actually proven to be deadly was absurd. If we're exposed to the health risk and we are trying our best for people to be healthy, why would we invest in something that is scientifically proven now for more than 40 years to be increasing your propensity to develop lung cancer? So we chose as a value to divest from tobacco. Do we think that's something that everybody should do? No. And I know plenty of countries that actually think it's, tobacco is calming you down or whatever. This is a value choice. We think your values should be reflected in your exclusion. If you think, which we have some clients, institutional clients that represent religious interest, whatever the religion, they have their values. They ask us to integrate their value in their portfolio. We can do that, whether it's certain, pork production, or they're against oil and gas. You want to divest all oil and gas. Yeah, we can do that for a dedicated mandate. As a firm, we don't think it's immoral. And so we haven't divested from that. Palm oil, yeah, we actually think it's, if not immoral, it's damaging to the economy, to our business model. We find climate change something very, very important. So no, we haven't divested oil and gas, but yes, we have an oil and gas exclusion policy that is targeting the dirtiest way of extracting oil and gas. So Arctic exploration, tar sands, and fracking. So those are values. It's a first bucket. We consider that's not the reason you do ESG. Do exclusion policy, exclude the ones that are like diametrally opposite to your values. And then there are another two reasons I can think of. And I must say that for a very long time, we were a bit confused about the two. One is financial materiality. The other one is reputational risk. I must stress that it's not at all the same. The perfect example until this year was Facebook. So Meta now. Facebook has been in controversies in the press for, I think it started in 2010. 2010, you were like, Facebook is a bad company. It's one of the best performer in the stock markets for a decade. So you could say eventually they were caught with the bad buzz, but we don't think that's an ESG risk. It's a reputational risk, maybe, and maybe you don't want to be exposed to that. But you can't say that it had financial materiality, not for a decade. So that's probably not the same. There are plenty of other examples, actually, where it's the reverse, where ESG risk materialized, and it didn't do bad buzz because people didn't pay attention. So we wanted to separate the two. And what I learned as a quant, as a data scientist, if you want two objectives and they're not perfectly correlated, and trust me, those two are not, you need two tools. So don't get confused about what you're doing. Either you think it's about your values, or it's about, I don't want the name of my firm in the press saying AXA was invested in that like super bad company that is very evil, or it's about financial materiality. MSCI makes extremely clear that their entire framework has been designed for financial materiality. That's what we use ESG scoring for at XIM, the ESG risk premium. And then the reputational risk is very important to us as well. And to some of our clients, it's even more important than to us. So you use a different data source. And I can be public about it because it is actually public. We use Sustainalytics. So we use Sustainalytics controversies, which we actually find to do a better job at tracking controversies and therefore at avoiding reputational risk than any other. So we've been using that for years to track high controversy. So they have 5 levels on at least 10 different topics. So we can track and check on the labor market, labor conditions, on the environment, on the supply chain. And so we have a screening, and we focus on that risk through that specific metric, which is a different data provider. ESG scoring, financial materiality. What's great with that is that every single year, even every month, but it's a bit idiotic to spend that much time every month, but every year, and actually every half year, we can check how it has performed. What is the ESG risk premium? And what we found in 2020, we did a historical study, and then every year we checked 2020 positive ESG risk premium. 2021, again, positive ESG risk premium. What does that mean? That means that if you're long the good ESG scores and you're short the low ESG score, in the case of a standard long equity portfolio or long credit portfolio, you wouldn't be short, you would be underweight. Doesn't really matter. At the end of the day, what's your performance against your benchmark? Both years, positive. There are plenty of ways to check that. And what we've checked is, and that's another point, is even if you accept ESG, which is what we do as a financial materiality indicator, so it's about the risk premium, it's about performance, which is something also we find very palatable to our clients. So it's actually a way to enhance your risk-adjusted return by reducing your risk and increasing your return, mainly reducing your risk actually, and you can actually measure it. And then what you can check is, it's not about the countries, it's not about the sectors, and it's not even about style. Because what's very true is, and it's again very well said in the CFA ESG manual, is that ESG scores are correlated to other investment factors. It's correlated to size. It's pretty obvious. It's about disclosure. If you're a big company, you have a guy, maybe more, who spends time disclosing information. So you have a report, sustainability report, activity report. You possibly have an entire investor relationship department. If you're a smaller firm, you probably have less resource to do that. And so you disclose less. Now you could say, and we know that ESG data providers penalize non-disclosure, and rightly so. Because if you just give the average score for non-disclosure, well, then you're creating an incentive not to disclose for bad players. So you have to penalize disclosure. It's morally right because you want more disclosure. You want to understand, you want your light to be not just under the street light, you want the street light to lighten the entire street, to see everywhere, not dark corners. So you want to see everything. So you need to encourage disclosure, and everybody's doing that, regulators, clients, forums, but ESG data providers are doing it as well, and it's a good thing. And two, in terms of providing us with a risk premium, it's also important to lower, not to just to give the average. If you don't have the information, assume that it's probably less good than you could think. Of course, it's unfair. And the fact that it's penalized is probably, in a lot of cases, is penalized wrongly. If the information was there, it would be better. Of course, on average, it's possibly true. And therefore, there's this correlation with size. There's a correlation with quality, which is probably a factor of investment that you know. So if you do factor investing, it's correlated with size, quality, low volatility. The thing is, we can run a portfolio through that model. So we use BARA a lot, which is a classic risk factor investing. And still, after correcting for all of that, we still find a positive ESG risk premium. So it does what we want it to do, which is to provide extra risk-adjusted returns to our clients. Now, the last question, which is kind of the Warren Buffett question, And that's probably like one of the wisest guy in finance. So I try not to ever disagree with him. So I'm going to agree with him. He basically said, well, come on, we've spent so much time looking for alpha. Surely this is not new. I think he's right. I think this is not new. This is a framework to capture something we were already looking at. It's been 40 years that every single investor is looking at good governance. Bad governance is a risk, and it will materialize financially at some stage. Everybody has been looking at it. Then it went to E, environment. First through pollution, because we were all aware that you could get fined for pollution. Water pollution, air pollution, and now it's climate change. And we know we'll get to stranded asset. Carbon price is rising. So the financial materiality is clear. G, then E. S is kind of nascent. It's always been a bit there. So labor conditions can cost you a fortune. Supply chain problem can cost you a fortune. Can we all agree on what is good and bad S? No, probably not. There's way too much culture still in there. But the idea that what you've done is basically a checklist to create a framework that you already had, but now it's organized. For sure. Is this something new? Not entirely. And therefore, it's just a risk premium. If you go back to the very start of my presentation, and now that you know that it's a risk premium, is it a problem that there is low correlation? Not really. That's the thing. There are two reasons it's not a problem. One, maybe we are just not trying to understand the same thing. If one is trying to have values, the other one is focusing on reputational risk, and the third one on financial materiality, no wonder they disagree about the result. That's one. And second, even if we all agreed that it's about financial materiality and finding a positive risk premium, do you think there's only one positive risk premium? No, there are plenty of risk premium. There are plenty of ways to make alpha, and they are not always correlated. So you can make alpha by doing good value investing. You can do low volatility investing. You can do growth investing. There are various strategies to extract alpha. It doesn't have to be all correlated. Okay, I go back to where I was. I think I can skip that because I talked about it already. So how does it work in practice? And that's, I guess, where I'll stop. I've given some examples on fixed income and then on equities. I think I've put that. The choice we made at XIM quite some years ago, and it's been amplified 2 years ago, is to stop having a central responsible investment team. It was a bit of a bold move, I have to say. But the idea was to say, this is so important in what we do, because now it covers all our assets, that everybody should be part of this. It's not just a central team somewhere, everybody does that. So the starting point was, let's stop having ESG analysts that review companies for ESG risks. You already have people who review companies and look at risks. It's called a corporate analyst. So a credit analyst, an equity analyst, train him, explain to him what is ESG. You know what? Even take the CFA ESG, most of them already have the CFA. Like the large majority, I'm not even sure one doesn't have that anyway. So just make them. Why? Because they spend their entire day, their entire life looking at a sector, and in that sector, so let's say you go to the car maker analyst, he knows every single one of them. What is the structure of its balance sheet? What is it? What are they selling? What is their range? Their profits, their employees, their conflicts, their credit risk, the valuation. Yeah, of course they can look at ESG risk. They're basically already doing it. They just don't know that they're doing it. So that was our starting point. Get the corporate analyst, widen your research on equity research, on credit research, on high yield research, and get them to look at ESG as well. They're already looking and screening at every company. They're next to the PMs, to the portfolio managers, next to the portfolio managers every day, and discussing which one to pick, which one to put in a portfolio, and doing what we call the relative value call. So for the same risk, which one offers the more value? For the same price, which one offers less risk? That's what they do. And then we also, so that was kind of the starting point. Then we looked at embracing it into other dimension. When we did portfolio construction, when we did fund creation. So you know how you do that. Model portfolio according to duration, yield to worst, credit rating with the distribution, the average credit rating, and then you add one layer. That's ESG, and possibly E, S, and G as well. With screening, with an average, what does the distribution look like versus the benchmark? That's what you do. Equity is quite similar, I would say, because of what is equity investing. It's a bit more what we call the ID generation. So the way it works is when there's a new idea, so a new stock that a portfolio manager wants to invest in, you create what's called an investing thesis. So you explain to the desk, to your team, to your investment team, this is why I think we should invest in AXA. It's a great stock. It has this, that, and the other, and like over 3 years, I think it can go there, and then liquidity, and this is the volatility, and this is what I looked at. In that moment, the IG generation, you add the ESG lens. And so it means a full review of the ESG risk at ID generation, meaning when you integrate in the portfolio. When we do the portfolio review, that means that the investment oversight committees that we have every month to check that we are doing in our portfolios what we promised our clients from an investment performance perspective, from an investment guideline perspective, we've added another lens, ESG. Do we do what we promised we would say in terms of ESG? Very, very concrete example. This is, and I've taken out the name of the company. This is an example where we have the review by a corporate analyst in the credit research team, where they flag an ESG risk, an ESG opportunity, which is something I haven't spent much time on. And so I think I've removed the name. Yeah, good. And so because, so in between two review, as in when they do the credit review, they will also do the ESG review. And because of either or both, they will revise their judgment over the long term. So long-term credit risk assessments, which we have an IG 1, 2, 3, 4, 5 rating, and then the directional view, for which we use colors. This is another one. So the previous one was on an environmental risk that is flagged by a corporate analyst. This one is on a governance issue. So you might say it's much closer to credits, and then something that they would probably have looked at even without having the ESG background. But because you're putting that lens, you make a list, literally a checklist. It's like, have you looked at, and then ESG, and in E, you have a list of what you should be looking at in terms of financial materiality. And I go back to, why did we move to a unified input with one data provider? Is because in a sense, for a given company, it gives you a benchmark. This is your reference. Now, what do you disagree with? And what do you think is missing? What have they not paid attention to? That you would want to replicate what a dedicated ESG analyst provider with 250 analysts has been doing for years is a misallocation of resource. What you should do is due diligence, and I'm not telling you to take MSCI, take the one that is the closest to what you think you're doing this for and test it. And then once you've understood and chosen what you think is the right thing to do, go into the details, which are the names where you're very surprised by the judgment that is not what you thought. And the guy, it's not just you know a couple of corporates. No, it's a credit analyst who is specifically looking at a given sector. He spends his entire year looking at the European car maker industry. And so it's not just a value judgment. He's looking at those risks every day, at those companies every day. So that is not the assessment he expected. Then you can delve into the details. Research report. I stop there. Oh, we have a question. Curious to know what's the weighting of the ESG in Access internal rating. Is it industry sector dependent? Yes, it is industry dependent. It is not uniform. And so it is matching where we think, so the weighting is actually done under so we call ESG pillars. And so at below pillar, there are key issues that are looked at. The weight is different on key issues. So obviously, when you sum up all the key issues in the environmental pillar, you end up with a weight that is different. But it's quite granular the way the weights have been optimized. But yeah, they're optimized by sector. And then how much of the ESG sub-ratings are data dependent, quants, and what's the percentage of so-called subjective quality judgment? Yeah, that's a very good one as well. The answer depends a little bit on what you're looking at. So again, it's a question of allocation of resource. So I'll get back to this figure. What MSCI is providing is as exhaustive a coverage as you know we can find, and so we're not trying to do 100% coverage of the universe. We're trying to do 100% coverage of our investments, and so typically the orange triangle, we're not asking them to do this for fun, and so whenever there is a qualitative assessment, it's because the name is not an MSCI, but is of interest to the portfolio managers. And so just to ballpark on the high yield research, we have more than 150 names that are invested or have been invested. I don't know that they're invested today, but at some stage they were invested and therefore they justified for a corporate analyst to take the time to do the research and to provide us with an ESG score. I think we're between 150 and 200. Small mid caps, I think we're at 60 plus names, where again, the small cap universe is probably what, 13,000? Yeah, I mean, if I go to my boss and I say that I want to have a research department that covers 13,000 corporates, I think that I went crazy. So no, it's 60 to 70. Are they all invested today? Probably not. But were they invested, or at least part of an investment thesis at some stage? For sure. Otherwise, the corporate analyst wouldn't have spent the time. What's interesting is that it creates an interesting ex post bias in the rating provided by your research. Let me explain for a second, which alerts usually your risk management, if not your supervisor. When you look at the ratings that research has provided, they're quite good, meaning they're quite high. And so the reflex, if you don't think of the bias, is to say, right, so you scored well all the companies that you reviewed because you know they were of interest. No, what you're missing is the ex ante bias. When a portfolio manager says, oh, I'm interested in company X, would you mind reviewing it from an ESG perspective? The analyst is probably going to go, yeah, no, but that's a terrible ESG rating because this, that, and the other. So honestly, I mean, I can do it for you, but I promise you it's not going to be a good score. So you're not going to put it in your portfolio. Oh yeah, right. Most of the time, that's where it stops. The portfolio managers know it's not going to make it to its portfolio. Sometimes the ESG analyst will do the analysis, and midway, when presenting it to the portfolio manager, the portfolio manager will just drop it and go, all right, well, if that's going to downgrade my ESG risk for my portfolio, why would I put it in there? And so it never ends up being necessarily documented because the research was either never finished, never used. Sometimes it was not even started. So what we've done on the high yield side is they were doing their own research in their corner whilst we were building this. And at some stage we told them, okay, send us all the names you've scored. And out of those, quite a few were scored by MSCI. And so we took that that was the same, and it's 100 names at least. And we thought, okay, well, that is a common sample. Let's see how diverse they are. And of course, I mean, I've shown you the correlation. This is not, but did it look like that? Not quite. The correlation was actually quite, it was 60%. Is that great? Well, you know what? It's good enough. 60% in ESG, it's quite good. So we're close to that. On top of that, you can look at what are the names where you disagree. So you go back and you say, okay, we're back to this slide. We can agree to disagree. So I give you back 3-4 names that explain most of the decorrelation. Are you sure? Are you sure you're comfortable with this? Can you show me? And then I'll download the MSCI ESG report and we'll see what you have to say. And if we disagree, that's fine, because we can actually go to the client and say, here, this is what we disagree. What do I have? I go down. What is the quantities? Right. So excellent question. Yes, at the end it's about resource. I mentioned it. At XIM and a corporate analyst covers about 80 companies, 60 to 80. Is that a lot? I have no idea. I've never been a corporate analyst. I mean, at some stage I was their boss when I was head of research. They didn't seem to. It was a lot of work. You could tell that they were under stress, but they were not, you know, dying. It's like they actually enjoyed their job. So I think it's quite standard, 60 to 80. That's it. What's your investment? What's your investment universe? If you're going to have the entire coverage of the MSCI ACWI, that's 3,000 names. If it's 60, you need 50 analysts. That's a lot. We don't have 50 analysts. Not to mention that, so we have more like 35. On top of that, if you only have MSCI ACWI, you have only the 3,000 top market cap. So very few emerging market, no small mid caps, very little high yield. Okay, so that's a very bad allocation of resource. So it's much better so you just.
I think something wrong went to the connection of Laurent. Laurent, are you here?
Yeah, I'm back. Sorry.
Okay,
I'm back.
don't worry. Welcome again,
okay.
Laurent.
The question was, how is performing the ESG Premier this year, which, as you know, is it's a bad year for ESG. That's true. It's basically a bad year for us as mankind. We haven't done the analysis. We're waiting for, so as I said, half year. So we'll do that early July. And you're right. I would not be surprised that we get a negative risk premium. And I think it's a good thing to say it to client, to say that. To be quite transparent, do you want to make a profit of a war? Because it is what's going on. There was a war. It disrupted the supply of oil and gas. It disrupted the supply of wheat. Is that something that we're unhappy not to have made performance from? No, probably not. But again, our ESG scores are industry rescaled. So I can see how that's going to be the conclusion. And at the same time, let's check, because within the same, again, it's sector rescaled. So that means that for ESG scoring to be bad, you need for it to give the wrong signal within a sector. So is it true that this year, in the dirty rally, the worst oil and gas players rallied the most? So it was the year not just where you wanted to be long commodities and long energy, you should have been long the worst oil and gas possible. Is Arctic exploration providing alpha? I'm not so sure. And so maybe in a sector we scale, which is literally what we use, maybe it's not that bad. And that's how we integrate it. We'll see. And again, if it is, I think we can live with it. What's for sure is, again, remember the expression ESG risk premium. If there was a risk premium that was always giving you alpha, then it would be in the price. It's called a martingale. It's like there is no such thing. If someone ever sells you that at the casino there's a strategy to always win, you're being tricked. It's literally not possible. You can mathematically prove it. And the stock market is the same. It is true, and to me the stock market is like poker. So you probably know the movie Rounders with Matt Damon, and he has the sentence: if poker is only luck, then how comes it's the same 10 people that are around the last table in the World Champion League every year? I think that's very true. It's not just luck. Is there luck? Of course there is luck. In the sense that it's not luck. I don't like the word, but there's random. There are probabilities, and you can get it wrong for the wrong reasons, and you can get it right for the wrong reason. But do we have some portfolio managers that systematically, year after year, over a long period, manage to extract risk-adjusted return that manage to beat benchmark? We do. And obviously that's what the client are checking. And when you no longer do, you lose your clients. So it's not systematic. It's not a science. But on average, over the medium term, typically a mandate is 3 years. Yeah, over 3-5 years, there are winners and there are losers, and it's not random.
Laurent, I have a question regarding quality of data. Right now, data is really important. We need it for principal adverse impacts. We need it for net zero commitments. What's your opinion about the quality of data? Then I have a second question that it's more regarding you have been talking about best in class and the risk, financial risk of the ratings. What's your opinion about the fund managers that are looking to improvers, for example, to try to play those companies, not that are best rated, but the ones that are making a big effort in order to improve their actual situation, and that they claim they can, have some alpha picking those stocks. Thanks a lot.
No, thank you. I mean, funnily enough, both questions are related. What you're referring to in the latter is ESG momentum, kind of like betting that you're buying the bad guys, but the ones that are improving. So bad but improving is it better than good but downgrading? The problem is, to do that, you need for the difference between 2 points to be informative. And so if you have a significant uncertainty over what you're measuring, which we know is the case and relates to your previous point about data quality, but also low correlation between providers. If you're not sure what you're measuring with a wider enough range, then doing the delta of two things that you don't know what they are is not meaningful. You'll probably know this about political polls. So ahead of an election, all the countries run polls to know what are the intention of the voters. You know that most of them are not too bad, but of course they get it wrong as well, time and time again. What's and that means there is an uncertainty, and most pollsters are very transparent about this uncertainty around what they're measuring. But still, journalists can't help but say, oh, that guy, the former prime minister, he lost 1 point. They know that the number they're discussing is not true by a margin of 3 to 5 points. They know that. The pollster says so, and they're still discussing a downgrade of 1 point. The downgrade of 1 point could be an improvement of 2 points, because there is no difference between an improvement of 2 points and a downgrade of 1 point, since there's a 3-point uncertainty. So we're doing it in journalism all the time. And in ESG, I find that ESG momentum is exactly that. Whereas credit rating, when you've reached a point where correlation is 92% and you basically know what you're measuring, yeah, of course you should buy double Bs, hoping that it will re-rate. All the credit managers do that. They buy high yield, hoping that this will turn into an IG. And the reverse is the nightmare of an investment grade credit portfolio manager. Buying triple Bs because that's where the widest spread they have, so the widest return. And bam, the fear, the absolute fear is fallen angels. Go into high yield. A lot of clients, for different reasons, including regulatory capital, don't want to hold high yield, especially not when they've bought an IG product. So it's kind of like buy triple B and cross your fingers, or have a very good credit research that there is no fallen angels. In the case of ESG, considering the uncertainty, I find that it's a bit presumptuous to imagine that you actually measure well those differences, or it would have to be very large improvements. And then going back to your data quality points, I think what's very welcome in the supervisor that we have across Europe is that you can't just say, well, I'm using MSCI or Sustainalytics or S&P True Cost, or that's not good enough, because those are your data. So you have to check. And yes, it's resource intensive and it's annoying and it's not a fun job. But you can't just say, well, they told me so. No, that's not how it works. They're not managing the money, you are, if you're an asset manager. And if you're an asset owner, it's your money. So you check. Those are your risks. It's not MSCI's risk, it's not Sustainalytics risk, it's your risk. So you check, they tell you stuff, and you own the data. And it's an awful job, as in, I hate it, because it's not the fun part. There's a famous French writer, Gustave Flaubert, who said, art is 1% inspiration, 99% perspiration. It's very much like that. Data science is 90% data cleaning, 10% fun modeling. This is it. It's the reward you get for all the dirty work you've done. Sometimes you manage to hire a guy who actually enjoys data cleaning. If you have a guy like that, hold on to it. Him or her, I don't know, keep him or her. Because you're very right. Data quality, if you don't do it properly, it's garbage in, garbage out. No value, no information. But to do it, to actually put, so you have to have a part that is automated. So you have automated data quality controls. For example, one that we have is you should flag when there are large changes. So the same corporates that has a score of 6 and the next day it has a score of 9. Whoa, are you sure? So you should check. So there are plenty of kind of automated flags that we have to check the data quality. But again, it's not a fun job. So it's cool when an artificial intelligence is doing it for you. But at the end of the day, yeah, sometimes you need to, lift the bonnet and check like, well, what's going on here. And it's a lot of work. Will we get to a point where all of this is crystallized and clean? I think so. I think at some stage, all of this will be commoditized. And when you buy your financial data access to have prices and duration and all those investment analytics that we get for free. I mean, my boss would kill me if I said that it was for free. You'll have the ESG rating as well, and plenty of other stuff. And the data will be cleaner. Again, if you remember the journey I shared with you, where we are in the cleanness of ESG data, and I mean ESG scoring, I mean, we'll have to wait 5 to 10 years to have that for climate data. So climate data today is really bad. Like, I mean, you get two numbers, they absolutely don't mean the same thing. So it's super labor intense. You have to look into a lot of things. That's where we were in ESG scoring 10 years ago. So honestly, I wouldn't say job done, but a lot of job has been done. And so then you have to, of course, think, where do you want your resource? That was it for me. Thank you for your attention.
Okay, I don't know if there's any other question for Laurent. Okay, I think you left everything very clear, Laurent. Thank you, AXA Investment Management. Thank you, Laurent. I think it has been very, very interesting. It was really a pleasure to have you here in this Zoom meeting. Thanks from the CFA Sustainable Committee and from CFA Spain for being here.
Thank you for having me. Have a good night. See you.
Bye.